This is huge, guys. Wait till you hear this information. All right, so here's the huge news, guys. Everything comes down to affordability, and that is the main issue right now in the United States regarding home prices. The average mortgage payment right now is $2,600 per month. Now, just to give you a little bit of a breakdown, your housing expenses should never be more than 1/3 of your total gross income. So your gross income, if you're paying $2,600 a month, should be about $7,700 per month, or about $93,000 a year. Now, here's the problem. The average individual income in the United States is about $31,000 per year. The average household income is about $75,000 per year. So millions of people definitely don't even qualify for the average home price here, because many people are far underneath that $93,000 income. Now, here's the other issue. The issue is that interest rates are continuing to rise, which means it's going to become even less affordable for most people. And in the next few segments, I'm going to show you guys why things are getting out of hand and why you should definitely be patient going through this year in terms of buying a house and waiting for home prices to come down. All right, guys, this is the first of several segments that I want to show you as to why I think the housing market is definitely in big trouble as we go through the rest of 2023. I want you guys to watch this quick little 1 minute or so video from CNBC News talking about the overall housing market, particularly also in my neck of the woods in Las Vegas. So let's take a look at this segment and then we'll come back to it.
Today's sell-off dragging rates lower, though the 30-year fixed mortgage rate is still hovering near 7%. And now home inventories are surging in certain markets as a lack of affordability curbs demand. Diana Olick here with the latest details. Diana.
Yes, Ari, the mortgage rate is right below 7%, but still bouncing up and down again. And new inventory and pricing data is showing why we're seeing a uniquely volatile market. After dropping sharply in January, the monthly payment required to purchase the average home jumped by nearly $100 by the end of February. At current income levels, it now takes just over 33% of the median income to make those payments. 24% is the 30-year average, and that's according to Black Knight. Now, that's nationally, but some of the least affordable markets are now Las Vegas, Nashville, Seattle, Miami, and Los Angeles. We actually went to an open house in Las Vegas last weekend. Just 2 sets of buyers came in 3 hours. The agent said inventory there is rising fast.
Especially here in Las Vegas, a lot of people moved from California thinking this could be where they were going to live in their no state income tax haven, and then got the call from work after COVID saying, nope, you got to come back home.
In fact, inventory in Las Vegas is now up 200% from a year ago, and prices dropped in January, but then rose into the first week of March, according to Parcel. Why? Well, those are closings, so contracts signed in January when mortgage rates hit 6%. Along with Vegas, Parcel is also seeing homes go for well below list price now in Phoenix, Tampa, and Charlotte, all of which were some of the hottest markets in the first part of the pandemic. Now, Sarah, not so much.
All right, Diana, thank you very much.
So it's pretty clear, guys, after seeing that segment, that a lot of the housing market is in trouble, particularly in my neck of the woods here in Las Vegas. Inventory that you saw in that segment is up well over 200% from a year ago. And that's, again, because interest rates are soaring. We're at 7% plus for most people on an aggregate level. And that's because when interest rates are this high, less people can qualify, which means less people can buy homes. So inventory is going to increase. Now, I think even though it's come down a little bit here in Las Vegas a little bit, inventory is going to continue to rise because I think interest rates are going to continue to go up as we go through this year. All right, let's take a look at this article, guys, that came out 2 weeks ago from the popular real estate website Redfin. There's a couple of key things to look at here. Let's first take a look at the headline where it says homebuyers' monthly payments hit all-time high as mortgage rates rise. Now, this goes back to what I said at the very beginning of the video. Because mortgage rates are soaring, so too are mortgage payments. So let's take a look at that more specifically here in this second paragraph. I'm going to read you this first sentence. It says, the typical homebuyer's monthly payment hit a new all-time high of $2,563 this week, up 29% from $1,988 a year ago. So basically, it's 30% more on your mortgage payment now than from a year ago. That's why the market has changed. Now let's scroll down here and take a look at this graph. Now this might look a little confusing, but I want you guys just to focus on this orange line right here, okay? This orange line basically indicates a $2,500 monthly payment, so that's the average. So let's just look at this orange line. I'm going to take the arrow right here to 3.5%. So if you had a $2,500 mortgage payment last year, right underneath that, if you can't read it, it says $495,000. That's what you could afford last year for $2,500. Now, let's scroll it down to current mortgage rates, to 7.5%, which is the aggregate. Right there, it says $355,000. So basically what that means is you have lost a third of your purchasing power just because rates have gone up so much in the past year. Now, just to prove this a little bit more, this is a long article and a lot of graphs on it, but I just want to show you the last graph right here, okay? This really tells the tale. Right there, you can see that headline. It says Redfin Homebuyer Demand Index minus 27% year over year. That means there's 27% less buyer demand, and it's for a reason. People can no longer qualify as much at these higher payments, and because of that, demand has dropped, and as a result, home prices inevitably are going to drop this year. All right, so as mortgage rates are soaring and less buyer demand is out there, take a look at this headline. It says homes in the U.S. are taking longer to sell now than at any point during the peak of the pandemic. And the subheadline here, if you can't read it, says the typical property sold last month was on the market for more than 7 weeks. So let's just scroll down here and just look at the specifics of that. In this second paragraph, I'm going to read it to you. It says, across the U.S., the typical home sold last month was on the market for 51 days or more than 7 weeks, the longest time they have taken to sell since February 2020, just as the pandemic was starting to take hold, and almost twice as long as the 27 days homes were selling in during that same time last year. That basically talks about how homes now are sitting on the market twice as long as they were before. And there's a reason for that, guys. People cannot sell their homes nearly as quickly because, again, there's less buyer demand, and that is going to continue as mortgage rates stay elevated through this year. All right, so this is an interesting article that just came out again from the popular real estate website Redfin. Take a look at this headline. It says luxury home purchases sink a record 45% to the second lowest level on record. Now, if we scroll down here to the secondary headline, it says that outpaces the record 37% decline in sales of non-luxury homes. So let's go here and take a look at this graph right here. Now, this talks about the red line here is the luxury home market. The gray line is the non-luxury market. So you can see how high luxury prices went up here. Right as we were in 2021, 2022, it just fell off a cliff right here, down 45%. The gray line here is non-luxury purchases. Take a look at that. That's fallen 37%. So again, this is the overall theme to the market. When the Fed continues to raise rates, interest rates and mortgage rates go up, which pulls a lot of buyers out of the market. But wealthier people also feel when the stock market goes down, they're not going to be spending a lot of money on homes like that because they're uncertain now of market conditions. So it just goes to show you whether you're on the low end or on the high end, the market is changing all the way through. So luxury buyers are not buying. Middle of the road buyers can't even qualify to buy with these mortgage rates. So it just goes to show you an entire 180-degree market shift from this time last year. All right, guys, so I wanted to include this article that just came out from Yahoo Finance. This is really shocking. Take a look at this headline where it says almost half of Americans earning more than $100,000 say that they're living paycheck to paycheck. So if we scroll down here a little bit, just to look at some of the specifics, it talks about right here, 6 in 10 Americans are living paycheck to paycheck. But right here where I highlighted in blue, it says about 47% of Americans who earn $100,000 were living paycheck to paycheck as well, up 4% since the month before. This is the problem in America, guys. It's affordability. Everything is way more expensive because we have such high inflation. That's why the Fed continues to raise rates. And I think they're going to continue through the course of the rest of this year, or at least most of this year, because people that say that they're done raising rates, I don't buy into that. They have to get affordability under control. And the only way to do that is to keep raising rates. And I think that's going to continue potentially through most of this year. All right, so now let's just finally drill down into my specific neck of the woods here in Las Vegas. Now, this graph chart shows the average median home price over the course of the last year. So let's do this. Let's take a look right here where I'm moving the arrow. March of last year, so basically a year ago, the median home price in Vegas was $465,000. Then you can see right here, I highlighted this in red, May of last year was the peak number, $485,000 for the median price. Now watch, as we go through the rest of 2022 and now into 2023, it's been a steady decline down ending the month of February at $415,000. So that's a good 10-11% drop since the peak of last year. Now, as I see that declining situation happening, I don't see a leveling off situation. I see these mortgage rates staying high, if not going higher as we go through this year. I think we have another 10% to drop minimum as we sit here in Las Vegas going through the rest of 2023. All right, guys, after seeing all of that data, I think it's pretty clear that we are in an unsustainable housing market. But let me give you a quick little breakdown as to how all of these dominoes could fall. Number one, we have soaring interest rates, which is making things very unaffordable for millions of people. When we have high interest rates like this, the next thing that typically happens is a slowdown in the economy or a potential recession. The next thing that happens after that is that unemployment goes up. That means if people are not working at jobs and there's less people employed, that means there's going to be even less people who could potentially qualify to buy homes. I definitely think this is the path we're on. I think it's going to be a slow grind down all the way through 2023 and potentially into 2024. But that's the way I think the housing market is heading as we go through this year. So I hope you guys enjoyed today's video. I also hope you appreciate my transparency. Like I've said, I'm always going to keep it real on this channel regarding real estate and the housing market. So with that said, guys, even though I think it's going to be a slow grind down this year on real estate prices and interest rates are going to stay elevated, take your time, be patient. I definitely have your best interest at heart. Just call, text, or email me anytime when that time is right for you, and I'd be happy to help you find that perfect dream home. I'll see you guys in the next video.